Hey guys, what's up? I'm Erin and welcome back to the channel. It sure feels like a recession is looming over us, like this ugly, ominous cloud. Media outlets are using every imaginable, scary, yet clickable headline to get you to read about this upcoming recession. The stock market is falling, cryptocurrencies are falling, confidence is down, inflation levels are high, the housing market is cooling off, and the Fed is slowly but surely increasing interest rates. So it certainly does feel like the beginnings of a recession, but we technically can't say that we're in a recession until we have 2 consecutive negative quarters of GDP growth. And thus far, we've only had 1 quarter of negative GDP growth under our belts. That's Q1 of this year, where the GDP fell by 1.4%. The next quarter very well may be negative, but the fact of the matter is, we're still living in the middle of it. Q2 doesn't wrap up until June 30th, and it's the middle of May. Measurable data on Q2 won't be available until mid-July, end of July, so we're still going to have to wait for a little bit to find out. So while the GDP data keeps us in suspense, there are other indicators that we can look at to see if we're heading for a recession. First, we have the yield curve. The yield curve plots the yields, or the interest rates, of government-issued bonds, and specifically what we look for is an inverted yield curve. An inverted yield curve occurs when short-term U.S. Treasuries are paying a greater interest rate than long-term U.S. Treasuries. Right now, we actually have a standard-looking yield curve. Here's our present interest rates, and you can see that the long-term rates are higher, not by a lot, but they are higher. Next, we have the Consumer Confidence Index. This reflects the general population's feeling about the overall economy, and to be honest, it's not looking so hot. Unemployment rate is another indicator. Naturally, society is going to have some level of unemployment, and it's said that if the unemployment rate falls below 4%, the probability of a recession in the next 2 years is about 70%. Presently, our unemployment rate is sitting at about 3.6%, so it's under that 4% threshold. You can also look at the average weekly hours worked by employees, because many employers will actually cut back on workers' hours before actually doing layoffs. And it does appear that we are having a slight decrease in the average hours worked. And finally, inflation. Inflation itself is often a big predictor of an impending recession. It's said that if inflation raises above 5%, that the odds of us having a recession in the next 2 years increases by about 60%. Currently, we're experiencing inflation at about 8%, so we've definitely hit this metric. And much of this inflation can be attributed to the Fed engaging in quantitative easing, basically printing money during the pandemic. During that time, the Fed printed an unprecedented $5 trillion, increasing our monetary supply by 27% across just a matter of months. To put that into perspective, under normal situations of quantitative easing, the Fed would aim to increase the monetary supply by about 7% over the course of an entire year. This time, they went at a rate about 4 times the normal rate. Now the Fed is trying to engage in quantitative tightening, which is the opposite of quantitative easing. They are trying to reduce the monetary supply and discourage consumers from spending by increasing interest rates. And the Fed's goal is to do this in a slow and controlled manner as to not cause a recession. This is what's called a soft landing, where the economy slows down, inflation goes back to 2 to 3%, interest rates gradually increase, and we all happily go on our merry way. And if they miss the soft landing, well, that throws the economy into a recession. But the problem is, it's not easy to do. To put it into perspective, the Federal Reserve was founded back in 1913, and to date, they have successfully engineered exactly 1 soft landing, and that was back in 1995. So, the odds that we're gonna get a soft landing? Probably not good. The problem is that the economy is very large and very complex, with a lot of moving parts, many of which are outside the Fed's control. The Fed can't just simply isolate inflation and try to bring that down in a vacuum. We are a global economy, and right now, there's not a lot of good news hitting the markets. Our inflation is higher than it's been in decades. China is having a resurgence of the virus that can't be named because it can cause this video to be demonetized, which further interrupts our supply chains. There's currently a war in the Ukraine, causing a great deal of fear around oil and natural gas. North Korea is testing missiles, food prices are increasing at a rapid rate, and the Tesla Model Y is backordered for 9 months, and I really want one. Historically speaking, the stock market and consumer sentiment have been overwhelmingly positive during times of quantitative easing. People like when the government is pushing money out there. However, during times of quantitative tightening, historically speaking, consumer sentiment and the stock market have a very negative reaction. So even though not all of the indicators are pointing directly towards a recession, many of them are. So it's probably safe to say that we are heading for a recession. And it's also probably safe to say that the Fed won't be successful in helping us avoid that recession by engineering a perfectly smooth, soft landing. Trying to predict when a recession will happen or how big its magnitude is going to be is really a fool's game. Looking at the indicators is good to do, but there's really no clear-cut signal saying it's going to happen in this month, it's going to last this long, or it's going to be this big or this small. No one really knows. We just have to wait and we have to live through it. But it's safe to say that a recession will happen because recessions happen from time to time. But I don't want to leave this video on a negative note, so it's worth mentioning that since the Great Depression, we have had 13 different recessions. The longest one lasted 1 year and 6 months. That was the 2008 financial crisis. We all probably remember that one. But the vast majority of them last just 6 to 10 months. Yes, every recession is different in its cause, different in how long it lasts, and different in how severe it is. But I doubt that this is the last recession we're gonna live through. What are some ways you can protect yourself during a recession? Well, if you're strictly looking to protect yourself from the inflationary pressures, government-issued I-bonds and TIPS are a great way to go because they will keep pace with inflation. I have an entire dedicated video on this and I will link it down below in the description box. Real estate has traditionally served as a good hedge against inflation. However, we are in a very interesting and seemingly inflated real estate market. If you're in the market to buy a home, know that you're buying for the right reasons. Know that you're going to live in this place for the long term, at least 5 years, maybe 8. Then it's probably still a good bet to buy. If you already own a home, I wouldn't worry too much if its value is going to decline because if you're not planning on moving, it doesn't really matter. If you're living there long term, that value will have time to come back up over the long term. What happens in the short term isn't going to affect you if you aren't planning on selling. And if you're a landlord planning on renting out properties, well, just remember, people always need a place to live still. However, another way to get good real estate exposure is through real estate investment trusts or REITs. And these trade on the stock market just like any other fund, so they don't require huge outlays of cash. I'm personally a big fan of medical facility REITs, so think hospitals, assisted living facilities, and nursing homes, because the way I see it, people always get sick and people always need medical care. And the cool thing about REITs is that they're forced to pay out 90% of their profits in the form of a dividend. So if you're looking for a good dividend paying stock, a REIT can be a good way to go. Commodities can be another good choice as well. Think energy, food, etc., things like that. These are all essentials that people need no matter how the economy is performing. And I very cautiously say that a small exposure to cryptocurrencies can be a good thing, but it's important to keep in mind that this market is totally clobbered right now as well. Ultimately, I always come back to my favorite asset class, the stock market. Yes, the stock market reacts very strongly to economic turbulence and to recessions, but the stock market always rebounds. If you believe in a better future, more business growth, better technological advances, greater prosperity for our nation, you believe in the stock market. The odds of every single business going bust are not good. And that's what would have to happen to completely wipe out our stock market. The stock market always comes back. And so long as you don't need the money right now, who cares what the market is doing? If you're 30, 40, 50 years old, a market downturn can be a wonderful thing. It allows you to buy stocks at a discount. It allows you to buy pieces of these companies at a sale price. What could be better than that? If you withdraw during a market downturn, that's when you lock in a loss. But so long as you leave your money invested, yes, the number in your account may look lower today than it previously did, but you don't actually experience a loss if you don't sell. So don't sell, don't lock in that loss. And if you're on the brink of retirement, I'd actually hold off right now. I'd wait a year or two or until the market rebounds. I wouldn't want to retire and have to sell off my investments during a downturn. I would continue to buy when everything is down and buy these pieces of stocks at a discount. This is what people talk about, investing during the good times and the bad. These are the moments where you're tested. Can you stay the course and ride out those rough patches? Can you continue to dollar cost average, knowing that your money is actually buying you more individual stocks at this time, knowing that the market will recover? Remember, 6 out of 10 of the market's best days are within just 2 weeks of the market's worst days. One last thing to help you through a recession, hold on to your job. Life is simply easier with a paycheck. And I am a huge fan of multiple streams of income. So maybe having a main job and then a side hustle and perhaps some sources of passive income, that's all great. But that's not just great during a recession, that makes life easier all the time. Especially helpful during a recession, but helpful all the time. The bad doesn't last forever, but neither does the good. Think about the previous recessions that you've lived through. How have they affected you on an individual level? You, your family, your household. Remember, the media will always hype things up and make them sound worse than they are. But what matters is your experience during the recession, not anyone else's, not what the media is saying, not what they're putting out there just to get the clicks. What matters is your experience. Focus on that. So what do you guys think is going to happen? Do you think there's going to be a recession? How bad do you think it's going to be? Share your thoughts in the comments down below. I love hearing your perspectives. But that's going to do it for me today, guys. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of anyone who might get something out of this type of content, please consider sharing. I hope you have a good one, and I will see you soon. Bye.